And it is not an accident, again, that gold is at a new record high. And while people were dumping shares in Newmont Mining this morning and Barrick Gold and Kinross and all these stocks, gold prices were going up. Right? Even though gold initially was down $20, it rallied, $35 from there. Why? Who was buying? Well, who do you think, right? The same guys that were at the BRIC conference, because again, they're not buying the mining stocks. They're buying actual gold. That's what they need. They're not making an investment. They are replacing US dollars with a superior monetary instrument that they can hold in reserve. And in fact, a lot of these countries, China in particular, are encouraging their citizens to go out and buy gold, buy silver, right? Our government doesn't encourage anybody to do that. We try to prevent you from doing that. So this is going to continue. People out there, some of these people are going to be at the New Orleans conference, George Gammon, Brent Johnson, they'll be there at this New Orleans conference, but they're on the opposite side of me, at least in the short run, when it comes to the dollar, right? I mean, I'm out there saying the dollar is going to crash, and they're saying, no, the dollar is going to surge. The dollar is going way up, and then it's going to crash. So they kind of agree with me that eventually the dollar crashes, but they just think it's going to have a huge rally before it does. And I think it's already had a huge rally. I don't know that rally is going to get any bigger. I mean, we have had a big rally in the dollar since the lows of 2008. The dollar index was down around 71, and now it's 104, and it did get higher than that, but that is a rally. Now, obviously, they think, well, the rally could be much bigger, and their thesis seems to boil down to the fact that there's so much dollar debt, and because so many countries have to repay dollar debt, that there's going to be this demand for dollars, because I owe dollars, so I need dollars to pay my debt. And the fact that these companies around the world that owe dollars, need dollars, is going to put all this upward pressure on the price of the dollar. And maybe if you just look at it superficially, all these companies have borrowed dollars, they have to pay back their debt, and then if they default on their debt, the people who were owed those dollars aren't going to get them, right? So dollars are going to disappear because companies are going to go broke because they can't afford to repay their dollar debt. And so all this is supposedly going to be bullish for the dollar. And I don't buy into that. First of all, that was true. Companies had a lot of dollar debt from 2001 to 2008, when the dollar index went from 120 down to 70. I mean, that was one of the worst bear markets that we've seen in the dollar. That was an all-time record low for the dollar index. I remember the dollar got down, to just 80 Japanese yen. It's, doubled since then, although it's pulled back from that high. But so the dollar was able to fall in that environment. And, the world still had a lot of dollar debt back then. In fact, the dollar was a bigger part of the global economy, as far as a percentage of reserves or trade than it is now. So it still happened. I think the people that are missing is that just because I owe dollars, I owe dollars to another foreign entity. So let's say, you're a Polish company that owes a German company dollars, right? You just did a deal in dollars, right? You didn't do it in zloty, you didn't do it in euros, you did it in dollars. So there's dollar debt on the books of this company. Well, when the Polish company repays its dollar debt, what is the German company going to do with the dollars? Well, it's going to sell the dollars to get euros so it can pay its expenses, pay workers, rent, dividends, whatever. So just because a debt is owed in dollars doesn't mean it's staying in dollars. So yes, there's demand for dollars to repay dollar loans, but then when people get repaid those loans, they sell those dollars, right? It's not like they're just going to hoard them, especially if the dollar is going down, right? If the dollar is falling and somebody has, is repaying you dollars, you might want to get rid of them as quickly as you can.
As we discuss these critical financial shifts, it's important to address the differing perspectives that are making waves in investment circles. On one side, you have notable experts like George Gammon and Brent Johnson, who predict a massive surge in the US dollar before an eventual crash. On the other, you have Peter Schiff, and those of us who argue that the dollar has already experienced its rally, and now it's on the brink of a significant decline. The question arises, who is right? Are we looking at a dollar surge before the crash, or has the time already come for the greenback to take a nosedive? Let's start by acknowledging the journey the dollar has already taken. Since the 2008 financial crisis, the dollar has experienced a robust rally. The dollar index, which was languishing around 71 back in those dark days, has climbed to around 104, even hitting higher points along the way. That's a substantial run. But the argument here is that this might be the end of the line for the dollar's strength, not the beginning of another rally. Those who foresee a further surge in the dollar argue that the massive global dollar-denominated debt will create an insatiable demand for dollars. The theory is simple. As foreign countries and corporations scramble to service their dollar debts, they will push the value of the dollar higher. And yes, on the surface, that makes sense. But here's where the analysis takes a turn. Just because a company or country needs dollars to repay debt doesn't mean that these dollars will be held indefinitely once the debt is paid. Imagine a scenario. A Polish company owes dollars to a German firm. When the Polish company makes its debt payment in dollars, the German company won't sit on those dollars. It will likely exchange them for euros to pay wages, taxes, or dividends. The demand for dollars might be temporary, but it doesn't translate into a lasting increase in the currency's value. In fact, if the dollar starts to weaken, there would be even more urgency to dump those dollars in favor of more stable currencies. It's a cycle that, instead of strengthening the dollar, could exacerbate its decline. Let's not forget history. The world was heavily indebted in dollars from 2001 to 2008, yet the dollar index plummeted from 120 to 70 during that period. The same conditions that supposedly should have supported the dollar back then didn't prevent a steep decline. If anything, the dollar's role in global reserves and trade has shrunk since then, meaning it has even less of a safety net today. The proponents of a dollar surge may be missing a critical point. The global financial system is evolving, and the dollar is losing its grip. Enter the BRICS nations. The BRICS, Brazil, Russia, India, China, and South Africa, are leading a concerted effort to diminish their reliance on the US dollar. Why should China and Russia, for example, conduct transactions in dollars when they can use their own currencies, or even something like gold, which has universal value? The logic is compelling. Using a third-party currency, especially one tied to a country like the United States, which is actively weaponizing its financial system through sanctions, doesn't make sense anymore. For years, global trade has defaulted to the dollar, not because it was the best option, but because it was the most established. That's changing. The recent BRICS summit highlighted a clear agenda, moving away from the dollar and building a more resilient, independent financial infrastructure. The shift won't happen overnight, but the wheels are in motion. And when they talk about using gold as a trade mechanism, you know they mean business. Why gold? Because it's a universal currency, free from the influence of any government. It doesn't require a central bank to back it up. Its value doesn't hinge on the fiscal policies of a single country. Gold has been a store of value for thousands of years, and no fiat currency, no matter how dominant, can claim that. Imagine a world where international trade is conducted in gold. It would create a level playing field where no single country has a disproportionate advantage simply because its currency is the global reserve. If BRICS countries decided to back their currencies with gold, they could eliminate the foreign exchange risk that comes with trading in fiat currencies. The Russian ruble, the Indian rupee, and the South African rand could all be tied to a stable asset like gold, ensuring that their exchange rates remain steady. This stability would make international trade smoother and more predictable.
If China and Russia want to do business together, or companies, right? The idea is for the buys or sells to either be in RMB or rupee, right? Not in US dollars. Now, because why? I mean, first of all, it makes no sense. Why should two countries that don't use dollars transact in the dollar? Just pick one of the currencies that's involved, right? You got two countries that have currencies. Why involve the United States, a third party who's not even involved in the transaction? Why use our dollars? Use the currencies that you're actually transacting in. And so that is the goal, right? For the BRIC nations to just phase out the use of the US dollar and use their own currencies. Now, maybe one day they will come up with a new currency. I think they should just use gold. I mean, to me, it makes the most sense for international trade to be conducted in gold. That's fair. That's arbitrary. You're not just picking some other, currency, because everybody uses gold. Gold is valuable everywhere, right? Everybody knows the value of gold. Gold is used in every country. And so you could use that. You don't have to reinvent the wheel and come up with a new currency. You got money. Just transact in real money. That's already there, right? You don't have to create it. You don't have to invent it. It exists. It's been here for thousands of years, right? That's what that they should use. And in fact, if these countries decided to go back on a gold standard where their currencies were all pegged to gold at a specific rate, and they kept that, then there wouldn't even be any foreign exchange risk. If the ruble is tied to gold and the rupee is tied to gold, or the zloty or the South African rand, if they're all fixed to gold, then their exchange rates aren't going to fluctuate. And so it would make it very easy to trade. Now, of course, if a government, somehow became reckless and irresponsible, and ultimately they might have to devalue. But if once you get back on a gold standard, you're much more likely to act fiscally responsible, so you don't have to devalue, so you can maintain the relationship that you've established. But in the meantime, what's going to happen is that the dollar is going to be reduced in the transactions. That's the goal. They want to move away from the dollar. And of course, if they're moving away from the dollar in transactions, well, they're also moving away from the dollar as a reserve asset, right? If you're not going to use the dollar as much, if you already recognize the vulnerability, they talked about at the BRIC conference, the political risk and the sanctions and all that. And that's another reason for them to step away from the dollar. So this is going to happen. And it is not an accident, again, that gold is at a new record high. And while people were dumping shares in Newmont Mining this morning and Barrick Gold and Kinross and all these stocks, gold prices were going up. Right? Even though gold initially was down $20, it rallied, $35 from there. Why? Who was buying? Well, who do you think, right? The same guys that were at the BRIC conference. Because again, they're not buying the mining stocks. They're buying actual gold. That's what they need. They're not making an investment. They are replacing US dollars with a superior monetary instrument that they can hold in reserve. And in fact, a lot of these countries, China in particular, are encouraging their citizens to go out and buy gold, buy silver, right? Our government doesn't encourage anybody to do that. We try to prevent you from doing that. So this is going to continue.
A curious development that underscores this potential retail awakening is Costco's decision to start selling gold. Yes, Costco, the same place where you buy bulk toilet paper and giant tubs of peanut butter, is now a gold retailer. And guess what? They can't keep it in stock. It's flying off the shelves. This signals a broader shift in public awareness. People who never considered buying gold are now seeing it as a viable option. If this trend continues and spreads to other major retailers, we could witness a new wave of gold buying that drives prices to unimaginable levels. We can't talk about gold without mentioning silver. Silver often lags behind gold in a bull market, but when it catches up, it does so with a vengeance. Historically, silver has seen explosive moves once gold establishes a clear upward trend. And silver isn't just a precious metal, it's also an industrial metal with applications in technology, renewable energy, and even medicine. The demand for silver is only going to grow, yet its price remains significantly undervalued. Central banks don't typically buy silver, but if rumors are to be believed, that could change. There are whispers that Russia and India are considering adding silver to their reserves. If that happens, we could see a seismic shift in the silver market. The price of silver, currently languishing in the $30 range, could skyrocket, especially if it breaks through key resistance levels. One of the most monumental shifts occurring right now is the global move away from the US dollar. The BRICS nations, along with a growing list of countries, are no longer content to be at the mercy of US financial policies. Sanctions against Russia have accelerated this process, as nations around the world have seen just how vulnerable they are if they continue to rely on the dollar-dominated global financial system. Russia, for example, has not only weathered the storm of Western sanctions, but has emerged stronger in some respects, largely due to its strategic accumulation of gold. The Russian ruble didn't collapse as many expected, and the Russian economy didn't implode. Instead, we're witnessing an extraordinary show of resilience. This resilience is rooted in their tangible, hard asset strategy, particularly their massive stockpiling of gold. It's not just Russia. China has been playing the long game too. For years, China has been quietly and systematically increasing its gold reserves, while at the same time encouraging its citizens to do the same. This isn't just about hedging against inflation or preparing for economic turmoil. It's a clear and calculated move to insulate themselves from the dominance of the US dollar. Remember, China is the world's largest producer of gold, and yet it remains a massive importer of the metal. That should tell you something about the seriousness of their intentions. Imagine a scenario where several major economies back their currencies with gold. It might sound like a fantasy, but it's becoming increasingly plausible. As we discussed earlier, gold is a universal standard that doesn't rely on the policies or stability of any one government. A gold-backed currency would immediately have credibility and value in a way that no fiat currency can match. Consider this. If BRICS nations decided to link their currencies to gold, it would fundamentally alter the global economic landscape. Trade agreements between these nations could be settled in gold-backed currencies, bypassing the need for US dollars entirely. This could severely weaken the dollar's influence, not just in trade, but also as the world's reserve currency. And let's be honest, the US isn't helping its case. The Federal Reserve's loose monetary policies, enormous fiscal deficits, and rampant money printing have all contributed to a growing distrust in the dollar. Inflation is still a significant issue, and as the US continues to rack up debt, other countries are understandably looking for alternatives. If we're heading toward a world where gold plays a central role in international finance, then the price of gold is likely to go much higher, and not just incrementally higher, think orders of magnitude higher. In part 1, we touched on the idea that gold could be revalued significantly, perhaps even to $10,000 or $15,000 an ounce, if it were to become the linchpin of a new global monetary system. Now, this might sound extreme, but consider the mechanics of such a move. If countries were to back their currencies with gold, they would need to ensure that the value of gold relative to their national debts and economic output was appropriate. The only way to do that is to revalue gold to much higher levels. Historically, this isn't without precedent. We saw something similar when Franklin D. Roosevelt revalued gold in 1933, significantly increasing its price to help the government manage its financial obligations. If such a revaluation were to occur today, it wouldn't just be a minor adjustment. It would be a seismic event that would send shockwaves through global markets. Gold would become the ultimate safe haven asset, and the demand for it would be unlike anything we've seen before. Now let's pivot back to silver, the often overlooked sibling of gold. Silver is unique because it's not just a precious metal, it's also an industrial metal. Its applications in technology, renewable energy, and medicine make it incredibly valuable. Yet despite its importance, silver remains drastically undervalued. The gold-to-silver ratio is currently much higher than historical norms, indicating that silver is incredibly cheap relative to gold. Historically, silver tends to outperform gold during bull markets. We've seen this pattern play out repeatedly. For instance, in the bull market of the late 1970s, silver's price skyrocketed from around $1.50 to nearly $50 an ounce. More recently, during the 2010 to 2011 run, silver went from under $10 to almost $50. If gold is set to soar, silver could easily follow suit, and its percentage gains could be even more spectacular. Some analysts believe that silver could hit $100 or even $200 an ounce in a future bull market. Given the current price of silver, that represents a tremendous upside. Let's not forget the massive short positions in the silver market, held primarily by a few large commercial banks. These entities have been shorting silver for years, creating a paper market that far exceeds the amount of physical silver available. If there were ever a run on physical silver, if investors demanded actual delivery rather than settling in cash, it could trigger a short squeeze of epic proportions. Imagine what would happen if one of these big banks decided to exit its short positions, or if a major player like a foreign central bank started buying up physical silver. The price could spike dramatically, and those short positions would become untenable, forcing a wave of buying that would send silver prices through the roof. This isn't just idle speculation. We've seen glimpses of this potential before, and given the current dynamics in the market, the risk of a short squeeze is very real. When it happens, it will be a rapid, chaotic event, and those who are positioned in silver will stand to benefit immensely. You might be wondering, if silver has so much potential, why aren't central banks hoarding it like they are with gold? The answer lies in tradition and utility. Central banks have historically held gold as a reserve asset, and it's universally recognized as a form of wealth preservation. Silver, while valuable, hasn't played the same role in modern central banking. However, this could change. There are already rumors that some central banks, particularly in Russia and India, are considering adding silver to their reserves. If this happens, it would be a game changer for the silver market. The demand from a single central bank could absorb a significant portion of the annual silver supply, pushing prices higher. As we discuss the implications of all these international moves, we have to come back to the elephant in the room: U.S. fiscal policy and the Federal Reserve. The U.S. government is running massive deficits, and the Fed has been forced to monetize this debt through bond purchases. Even as they talk about reducing their balance sheet or raising interest rates, the reality is that they're stuck. They can't let interest rates rise too much without crashing the economy, but they can't keep them artificially low without fueling more inflation. It's a classic lose-lose situation, and it's why many investors are turning to gold and silver. These metals aren't just hedges against inflation, they're insurance policies against the collapse of fiat currencies. As more people realize the precariousness of the current system, demand for gold and silver will only grow.